Hi guys, Harry Otis here, professional trader for 20 years now. Started my career in 2005, still alive in 2026. So today, a down day, Tuesday, 7th of July, right after the 4th of July weekend. The market was bid on Monday, but on Tuesday we're giving it up, down 0.5%. But is the war back on? Everybody's scared again. Oil is going up, gold is going down, stocks are taking a hit. What's going on? Okay, should we be worried? Okay, we'll get to that shortly. First, let's look at the technical picture. We always do, and guess what? Bullish. Bring in the moving averages. We're still trading above the 50. We never really got below it that much. Maybe there's one day here, but not really. Okay, we're still very, very bullish, technically speaking. Okay, the bears though are out in full force, and they do have a technical pattern that they could like hang their hat on. We still have a series of lower highs. Okay, but to me, technically speaking, this looks like a consolidation pattern before we rip higher. Okay, and this is, as you can see, alleviating the overbought conditions and getting basically flat for the next move higher. Okay, so technically speaking, still very, very bullish. Don't let all the hype fool you. Okay, we also have the sentiment. It's at fear. We were before. We were at the border of extreme fear, but now we're at close to the border of fear and neutral. We have plenty of room to go to extreme greed. If you look at the sub indices, the stock's price breadth, I expect this to go higher still, and we'll get to that shortly. But people started buying some calls. They saw this market going up for the past week here, and they started buying some calls, but I suspect that might be eliminated today. Who knows? Okay. But the point is that we are still in fearful territory. We're not even close to like greed and at highs. Okay, so this to me is very, very bullish. Both the sentiment and the technicals are very, very bullish. And of course, the fundamentals are bullish. Earnings up, jobs doing fairly well. And I think the rate hype is overblown. Okay, we're going to get the minutes this week, so that's why it's important. Let's check it out. But I think it's going to be a nothing burger. People are going to look past it, and so will the market. Okay, so let's get to the war back on news. Okay, stock, CNBC. Stocks are in trouble because the U.S. revokes Iran oil sales authorization after tanker attacks. So it looks like the war is like going to start over again. The Strait of Hormuz threat level raised to severe. Okay, all this fear. Okay, all this fear back on. Okay, so what can we see? Let's go into perspective. Okay, let's look at the oil market. Of course, first it's always about the oil. Okay, yes, oil pumped up. Great, it's up 5%. Okay, U.S. oil back up. But we were saying last week that we expected oil to bounce because we are in oversold, very, very low territory, okay? And this bounce higher is great because it alleviates those conditions. And if we bring in the moving average, you want to get more technical, it could literally hit the 200-day moving average from the bottom at around 74-ish. We are currently at 72. So basically $2 more, and we hit this, probably going to be some kind of resistance. And the neckline would be the next resistance, which would be the neckline of this big move here, which is at 79. So I don't even see oil getting there in the interim because I don't think the war's back on. I think this is hype. Okay, so oil back up. Yeah, but look at it from an extremely low level and oversold conditions. Okay, so it was vulnerable to a pullback, and we mentioned it, guys. Beware. We are getting into these conditions where we're hitting support and we're oversold in oil, so we're probably going to bounce. But I think any bounce is going to be lower high, let's say, and then even lower. I think this chart, U.S. oil, has a destiny with a $55 level. And again, it might touch that after we get back down to it. Again, same pattern here, go up a bit before going down. I think oil is going to see a very, very protracted down move as the weeks continue. Okay, so yes, we have the war news back on, but look, let's get some perspective. Okay, oil is still in a very bearish pattern. Okay, let's get rid of this moving averages. Go to gold because gold is always now. We were buying gold on this flush. We're still buying a bit more. However, okay, gold, by the way, gold is pro-cyclical. It's going with the market. The market goes down, gold goes down. Market goes up, gold goes up. And it's probably more positively correlated nowadays than in the past. In the past, it's slightly positively correlated, slightly. And now I think it's more. It might be 0.7 or 0.6 correlation, which is huge. It's basically a risk on asset right now. It's crazy to think, but that's the way you have to view it in the short term. And it's not because of, it's like a stock. It's because, like, as the stock market goes down, the reason is because of higher inflation, which means higher interest rates in the future, which kills gold. Okay, that's the theory, although we've debunked that. But, market participants are trading, and the history has debunked it, not just me. All you have to do is look at the period between 2002 to 2007. But right now, we still have a bearish formation on gold, technically speaking, and below the 200, and the death cross. The 50 crosses below 200. So you have all the negativity out there for gold. Okay, but like we said, gold always fools the technicians. It always looks like it's going to go down before it goes back up. And we mentioned it 1,000 times with 1,000 different metrics you can use for breadth. You can use percentage of gold stocks above their 50-day moving average, above their 200-day moving average. You can use the bullish percent indicator. Whatever you want to use is telling you that gold is in an extremely oversold condition, and so are the miners. And you want to be long, and this move is going to take months to play out, probably to the end of the year. Okay, we might get them. Whatever happens here, what I'm looking for next, by the way, is eventually for gold to decouple from the market and have its own move, but some kind of technical pattern that will break this downtrend, which means probably a higher low here before breaking up to the 4,400 level, which I think we're going to see during a summer rally into this big 4,400 level that starts from here, October 2025. We probably hit that before going lower again. Okay, so this is what I expect. We hit these key levels before going lower and going up again. Okay, nothing goes up in a straight line. It's zigzag fashion. And what I'm looking for next is a higher low on gold. Okay, so the final thing that I'd like to talk to you guys about is the relative strength of this market. Okay, we were expecting semiconductors to go down. This is SMH, a semiconductor index. Okay, and today it did go down. Let's bring in the moving averages below the 50. Okay, it touched the 50. This might be the actual buy point. This might actually be the low before it actually goes higher. We don't know, but I'm expecting this market to go down and sort of consolidate, maybe break the 50, stay below it for a while before going up. Okay, I'm looking to get in this sector. My favorite play is Mu. I'm close because I'm waiting for it to hit the 50 before I buy my first chunk. Buy, meaning before I enter long in some kind of long fashion. Mu. But it's still the same. It's still the same chart. I'm looking at SMH, and I'm thinking that this sector gives up its gains to a certain extent, not bearish, just goes down, sort of consolidates before going up again. And the fact that this market is going down is exactly what is pressuring SPY to stay low. Otherwise, it would be at new highs. Okay, so I like the fact that the SMH is going down and SPY is not really reacting, which means that the breadth is increasing. We have other plays that are picking up the slack and not falling. Okay, breadth here, and the stock price breadth should increase over time. It just doesn't happen right away. Okay, and the two trades that I'll give you guys two trades. We took more, but you want to go into the RSP basically, which is the equal weight index. Okay, look, that's strong. It's at new highs, basically a bit down from the highs, but you're going to see sector rotation. This is signifying sector rotation. As SPY is basically flat, you have the RSP, which is the equal weight, which means that there's less of a weight of these tech-heavy semi-sector effects that you see in the SPY. You don't see it here. So here you see more of the other stocks picking up the slack. Okay. You could always do SPY divided by RSP to see the relative performance. And you can see SPY has been underperforming for like a couple months now, which means rotation is getting into the other sectors. The breadth is going to be up there. Okay, it's coming back. Okay, so the two stocks that we traded in recently was Nike. We took on a Nike position because earnings came out and beat decisively, and I think this is a turnaround play. So you're having this positive divergence, meaning the price of Nike was going down as the RSI was going up and the MACD was going up. So I had a technical reason to buy, and we entered because we suspected that the earnings would beat because they would been beating before, despite the negativity out there in the fundamental picture. So I think this is a turnaround play. It's going to take time. I took a different type of options strategy. It's called the zebra strategy, and we went over it. We're not going to go over it again, but we went over it before. So basically, I have exposure to this stock via options, but on a 1-for-1 basis, meaning that as the price, it's like owning the stock. As the stock price goes up by $1, my option structure will also go up by $1. So I have pure 100% sensitivity to the stock price with a capped downside. Okay, and the other stock that we did this on was Sprouts Farmers Market. I like this. I think it's turning around. Earnings are coming up in July, the 29th. I'm waiting for that. I hope it beat, because they always beat. Okay, they're always doing well. They're not doing badly. And I think that might be the catalyst after a protracted down move for it to go higher. And we did a trade. We did a similar options trade to Sprouts Farmers Market as we did with Nike. Let's bring it up here in case you guys forgot. We bought the SFM. It's trading at 84 currently. And we bought an 280 calls and sold a 105 call expiring in January in 1 year. So we played it a longer term, because I really want to have exposure to the stock, and I don't want to be like shaken out by a short-term options play. And this is a debit. Okay, it cost us $2,500 per structure here, per 2 calls long and 105 call short. Okay, so and yet, just to show you guys that the delta was 94, almost 100, which means it's a 1-for-1 exposure to the stock. As you can see, right now we entered this a couple of days ago, and you can see that now we did it when the stock was at 88.89. It's down $5. Okay, we have 80 as our protection. Can't go lower than that. We can't lose more than what we put in. Okay, the 2,500 per contract, per structure. Okay. And look here, it's the 8th of July, and we're only down, the price went to 84, and we're only down 0.5% of this entire position. So it's holding up very well because of the long-term nature of this company. So that even if it goes up to 91, okay, which is very, very possible in the days in like next week. If it goes up to 91 next week, we're up 25% on the entire thing. This is why I like this upside. While the stock has been beaten down, you want to generally go into the sectors that you think in the future are going to outperform. And I think these guys have been beaten down and will outperform. But that doesn't mean that the SMH and semis will do badly. Okay, I really want to get into this game as well, and I'm waiting to enter on Mu. Okay, so that's it, guys. That's what we're doing. Basically, is the war back on? No, I don't think so. The market doesn't think so. This is a very muted response to war back on. Oil is telling you, well, yes, but we were expecting this. Any kind of spark would have lit in the fuse for this U.S. oil to go back up. I have no doubt that whatever technical level it hits, whether it's the 200 here or this neckline of $78, $79 a barrel, I think it goes back down again. I don't think that Trump wants to restart this war before the midterms. And I really don't think, Warsh is going to raise rates before the midterms as well this entire year. You know my thoughts. Okay, so that's why I think we're going to see oil going down. I think gold goes up over time, despite all this negative outlook here, because of the falling inflation expectations. And that's why I think the market itself will also catch a bid. To me, this is a consolidation at highs, almost forming a wedge, holding very, very tightly on the top at highs here, as the semiconductors were destroyed today. Well, the SMH was down, 4 or 5%, and the market's down 0.5. This is fantastic, exactly what you want to see. This is what a strong market looks like. All right, guys, I'll see you tomorrow.